Welcome everybody to Fidelity International's webinar today on New Life, Old Life. Just to set up a bit of housekeeping before we kick off with the webinar. The webinar will run for about 45 minutes. There is a Q&A section at the back end of the webinar, and you'll notice on your screen there's a Q&A chat function where you can enter your questions, and we'll do our best to answer all of those at the end of today's recording. So I'd like to introduce you to Richard Dinham. Richard joined Fidelity International in 2018 as Head of Client Solutions and Retirement. He's had over 25 years experience spanning Australia and the United Kingdom. Thanks, Richard, for joining us today. Over to you.
Great, thanks, Sarah. Thanks for the introduction and welcome everyone. Yeah, we're really pleased to be able to present some research that we've done recently around retirement, and we've called this piece "New Life, Old Life," exploring some of the thoughts and feelings of retirees as they approach retirement and into retirement. So on the next page, we have just a list of the areas after the disclaimer. We have. If we could go back one, please. Oh, right, sorry, I think we're missing the contents. Yeah, so look, just on the just as an introduction to Fidelity, we've been around since the 1950s actually, managed globally around 900 billion of assets around the world, around 20 odd billion or so in Australia. We're one of the largest global managers, almost 3 million clients around the globe. And we pride ourselves very much as a sort of research driven organization. We have one of the largest global research capabilities in the world. More than 400 investment professionals who conduct between them around 20,000 face-to-face meetings with company management. So it gives us a really strong insight into what is happening on the ground with the companies that we invest in, and more than 90% of our research is in-house, and that's really critical. We think we don't rely on insights from third parties that can get lost in translation, as it were. So that's just a quick introduction to Fidelity if you're not that familiar with us. But getting into the meat of today's research, the research we're looking at is around retirement. So we'll go through some of that first. This is the research that we carried out. There are actually two pieces that we have carried out recently. The most recent piece was in August last year, where we surveyed around 1,200 Australians over age 45, and we broke them down into three different cohorts, around 400 or so in each of those cohorts, and we're really looking for drivers of behaviour across retirees as they are approaching retirement, in retirement, and later on in their retirement. And we got some really good insights from that, and it was really built on a previous piece of research that we did, and we'll summarise some of that for you as well. We carried out that research in September 21, and that was an even larger piece of consumer level research. Australians over 50 broken down into four cohorts, and of course the relevance for today. Quite a number of those were members or trustees of SMSFs. So hopefully you'll find some of the insights that we bring out, particularly relevant if you happen to be a member of a self-managed super fund. So let's get into the research. So on the next slide, some of the key sort of insights that we found from that research is that many people who are thinking about retirement really find the idea of transitioning into retirement very appealing. So around 90% of respondents in the survey of 1,500 people found the idea of transitioning progressively through time, reducing work commitments rather than having a hard stop and completely stopping work on a particular date. They found that idea very appealing, and whilst that idea was appealing, people do need support in actually making that decision, making it happen. And so, 2/3, as we found there, we're looking for support in managing that transition. But whilst they needed that support, they didn't feel able to make all those decisions themselves. Only around 1 in 20 were actually receiving some form of advice. And really, this is something we'd advocate for. Advice can be very helpful in navigating the intricacies of retirement. It does get quite complicated. So yeah, that was the first sort of key insight. On the next slide, we're talking about, well, what does a successful retirement look like? And when you ask, if you ask a sample of retirees thinking about retirement, either in retirement or building up to retirement, you might think that being financially successful would be one of the most important factors. But as you can see, we've highlighted there in the box that being financially successful, whilst it is important, is far from the most important driver of what a successful retirement looks like. So you can see the number one driver there is actually, just being happy in yourself, being sort of happy, content, in retirement or building up to retirement. Those sorts of softer emotions are actually more important than financial success. Doing what you love doing every day, spending time with family, friends, hobbies, reading, things like that are, again, more important. Helping others, as we've shown there, number 3, and relationships, with friends, with family, being part of a community. Those 4 factors that we mentioned there are more important than being financially successful, and yet it's often the case that we focus most on the finances. And so hopefully this slide gives you a perspective on what are the priorities that people have when they're in retirement and building up towards retirement. And then on the next slide, thinking about transitioning. So how many people actually plan a transition to retirement? And what you can see there is that whilst 31% there have transitioned to retirement, they sort of eased into the retirement phase. And there was some planning involved. You can see at the bottom that 34%, so the biggest proportion by number there, actually did not plan their transition into retirement at all, building on that earlier slide. So we can see there that there's a lot of opportunity to improve outcomes in retirement by proper planning and thinking about all the actually quite a complex range of factors that we need to think about in building up towards retirement. On the next slide, thinking about some of those reasons why people do retire, and in this case, how do people, or what are the reasons that people retire early? And what we found is that it's in many cases people retire unexpectedly early through a range of issues, often related to personal health, as you can see there, number 1, or redundancy. Towards the end of your working career, unexpected redundancy, is a major cause of early retirement, or caring for someone else. You see number 4 there, 11% of people, need to care for a relative or perhaps a friend, as a reason for having to retire early. So there are a number of factors around personal health, either yourself or someone else, or redundancy, major causes of retiring earlier than expected, and that retiring earlier than expected can be quite a shock, and so planning for that in some way can be very beneficial to an experience in retirement. And then on the next slide, that intention, building on that previous slide, intention to retire, from the sample of 1,200 people that in the survey, how many retired at the expected age, and and how many retired early. And what you can see there, just to explain this chart, is that age 62.5, that's the age at which people started, that they intended to starting easing into retirement through a transition. But the age at which that was actually happening is 61.4, so more than a year earlier than expected. And then in terms of full retirement, the average expected age of fully retiring was almost 65, but in reality, it was 63 and a half was the age that people were fully retiring. So again, almost a year and a half ahead, or earlier than expected. So these, reality is many people are retiring somewhat earlier than expected, and in many cases that's can cause problems in terms of feeling of control. Have we saved enough, and so on. And so hopefully some of the insights that we're going to cover in a moment will help people think about those factors and start planning for the unexpected. So on the next slide, I mentioned a moment ago about control, and the sense of control is absolutely critical to the feeling of satisfaction and the experience that people have in retirement. And what you can see here is, from the sample of 1,200 Australians that were in our survey, some had retired early, unexpectedly, some retired as expected. It gave us a really good insight into how they were thinking and feeling during that process. And what you can see here is that those who felt completely in control had the highest level of life satisfaction on the left-hand side there, in the orange line. And you can see that orange line, as you move to the right there, individuals who didn't have a sense of control, their level of life satisfaction tapered off quite a bit. And so there is a very strong correlation, a very strong link between level of life satisfaction and the level of control that people felt when they were retiring. And similarly with the blue line there, you can see in terms of satisfaction with the level of wealth, as you can see on the left-hand side, those who are felt in control also had that, the highest level of, they felt in control of their wealth. And as they lost control, as that, as the blue line moves across to the right, the level of satisfaction with wealth also tapered off, and in fact more rapidly in this case. So, having a degree of control, when things happen in retirement, as we saw earlier, you can retire earlier than you might expect. If you lose that sense of control, then the level of satisfaction and concern, increases markedly. And so it's very much worth planning ahead for these kinds of unexpected events, to help build that sort of resilience, to help navigate these things that are often unexpected. So on the next slide, in terms of that advanced planning that I mentioned, and this is an interesting insight. Many people during the course of their career, put a lot of effort and activity around planning their career and building up a detailed, plan of careers and so on. But an interesting insight here is you'll see that, almost a majority there, between 44 and 60% of people are, as you can see at the bottom of the chart there, do not actively plan their wind down phase of their career. They're not thinking about how they will ease into retirement, and they will, adjust their needs and aspirations during that period, which is surprising. It's all the effort you put into building up your career, and then you're moving to the next phase of life, and for whatever reason, people are not planning, as much as you'd expect in that wind down phase. So potentially there are a lot of opportunity to improve, thoughts of feelings of control and so on, by advanced planning around that wind down phase into retirement. So on the next slide, some further insights, and particularly around SMSFs. And I mentioned earlier on that part of the sample that we had. We had 1,200 Australians in this particular sample. Quite a number were trustees of self-managed super funds, and so it was very helpful to help us look across the cross section and how SMSF trustees differed from the rest of the population. And what you can see here is that the self-managed super fund trustees are how often do they check their financial plan? You can see they score the highest there across the various categories. So SMSF trustees are, we can infer from that, are more engaged. They're more frequently checking their financial plan. They've taken control by establishing an SMSF or are a member of an SMSF, and so are and this is a pleasing result. Are more engaged in looking at the finances and checking that everything is on track. And on the next slide, there are, that said, there are some concerns. SMSF trustees still worry about money, and this is when we ask the question, how frequently did you worry about money, at least monthly? A third of SMSF trustees did have that concern, although happily you can see they scored somewhat better than the rest of the population in terms of members of retail funds, public sector funds, industry funds. So whilst we would like that score to be a lot lower through building sort of confidence and control, there are still some money worries that SMSF trustees feel with regard to their savings for superannuation. And then on the next slide, this is an insight from that earlier study that I mentioned that we carried out in 2021. We thought this would be, some useful insights here to remind ourselves of. When you ask a sample of people who are saving for retirement, what are your key drivers of your quality of life? What is most important to you, especially as you build up to retirement? And you'd expect, going into this study, we expected wealth and health to score highly, and when you ask people what is most important to you, those two factors come in the top two. But what we were able to infer from the questioning, and we had more than 100 questions for the people that we surveyed, and we're able to infer using statistical analysis what the actual drivers of quality of life or life satisfaction were. And this is a really interesting insight. You can see these are all ranked here. The results from that statistical analysis are shown here, and you can see there's 5 other factors that are more important than wealth and health in determining the level of satisfaction with life or quality of life. So, connection with your friends and community, having a sense of control, as we spoke about earlier, having a purpose in retirement is critical. Feeling that you're usefully using your time and benefiting friends, family, or society generally. Having that purpose is really important. Having confidence as well, feeling that's sense of confidence and control, and a number of these factors are linked. And then that emotional experience we found was actually the most important driver of quality of life, and that's around a sense of contentment and optimism. If you've got that sense of those feelings, then your emotional experience in retirement is much greater. And as you can see, for the mathematically minded, this model there was able to explain 87% of the variability of the outcomes in this study. So we think it's a really good model of explaining the drivers of behaviour and quality of life in retirement. So yeah, some really useful insights from that study. Okay, so on the next slide, we did ask those late stage retirees. We found that the later retirees had the highest level of life satisfaction and quality of life. And we were intrigued by that, and it was a useful insight that they were the ones who were most satisfied with life, and so we asked them what what is it that's helped you be so contented with your level of life satisfaction, and so these were the top sort of 8 factors that came out from that questioning, and I guess consistent with that previous slide where we talked about having a positive sort of outlook, and so having a positive and optimistic outlook was seen as if you've got that sort of mindset, you're able to navigate through the difficulties that inevitably you encounter in retirement. The unexpected things that can happen. And also important, they're investing in your health and doing that early. We know health deteriorates through age, and of course, so if you can invest in retirement, in your health, then that really helps with higher quality of life as you progress through retirement. And then you can see some of those other factors, being flexible and adaptable, having a plan B, taking control, those factors are all related. And that's around having resilience in retirement when you encounter factors that are, or experiences in life that are unexpected, a death of a family member, having to move, anything like that is a shock. If market events with your investment portfolio are negative, if you've got some flexibility, adaptability, and particularly if you have that plan B in place, that can be really beneficial, as you can see there, in helping you navigate through those uncertain times. And it's what we call resilience. Having that resilience is really critical to being able to have a long and happy, successful retirement. Okay, and then on the next slide, so just looking at some of the investment aspects of retirement. So what do Australians worry about most? We go to the beach a lot, but so do we worry about what's in the water? But actually, as we can see on the next part of this, it's actually, have I saved enough for retirement? Just having a bit of fun there. But on this next slide, we're thinking about the key risks that you encounter in retirement from an investment perspective. What are the key things that worry about? And this is almost a sort of 101 of the retirement investing. The key risks that you would face if you are building up to retirement and in retirement, there are 3 of these risks, and there's something called sequencing risk, or sometimes this is called market risk, and it's really around volatility of investment markets with your investment portfolio that you've saved for retirement. And we'll see an example of each of these risks, and certainly sequencing risk in a moment. So sequencing risk is probably the key risk that you face early on in retirement, when the investment portfolio is probably at its largest, before income has been drawn from it, and it does sort of ease down through time. But certainly a key risk. Inflation risk is critical as well, and as I'm sure you're aware, inflation has been increasing in the recent years and months. After many years of very benign inflation, we're now in an environment where inflation has increased very significantly, and we're seeing interest rates rise in accordance with that. So reducing spending power through inflation is when you're in retirement for a period of time can be quite an issue, and we'll see an example of that in a moment. And the third risk that people are concerned about is longevity, or how long will you live, and what is the risk about living your savings, and that can be a key risk amongst retirees. They can be very concerned about that. Have I saved enough? So yes, again, we'll look at some data on that to get an idea of what that risk means. So on the next slide, just to give you some idea of the sequencing risk that I spoke about a moment ago, and this is just a sort of made up example to illustrate what sequencing risk means. And this is savings profile for two savers saving up for retirement, and both of them were, at age 50 they started saving $10,000 a year, and they were increasing that at 3% per annum. Just as a simple example, both looking to retire at age 65. And what's interesting here is that the blue line, which is for Anna, who was born in 1942, and she retired at September 2007. And that was, and we've chosen an example around the global financial crisis to really, illustrate perhaps an extreme example of sequencing risk. But this lady retired at the peak of the market, and you can see savings there close to 350,000 at the date that she retires. Whereas the other saver there, Betty, who was born only 18 months later, and her retirement date when she reached age 65 was at the bottom of the market, you may recall, from the global financial crisis in March 2009. And she has only 150,000. So 350 versus 150. So they've saved exactly the same amount over the period of time that they've been saving. But one investor has almost 3 times as much as the other. That is perhaps an extreme example of sequencing risk, but is nevertheless a very real risk that retirees face when they are saving through time. And the market experience over their savings period and at the point of retirement can have a critical outcome to their retirement savings plan. Looking at the next risk. And this is around volatility in retirement, and what we have here is it's useful to remind ourselves of one of the perhaps quirks, if you like, of the investment markets. Many of us will look at our retirement savings and look at how that has performed through time, but there is a bit of a quirk of the way investment returns are presented, and just to run you through that, if you have a sum of money that that is invested in the markets, if you notice that is affected by investment returns. So in the example on the left-hand bar, if markets are down 10%, so your investment falls 10%, in order to get back to the same dollar value that you had at the beginning, you need an 11% positive return to get you, as I say, get you back to where you started. And that asymmetry of the way investment returns, the maths of investment returns works, increases, as returns get larger, either positive or negative. So if you look at the middle bar there, if your investment portfolio drops 30%, you need a 43% return, a positive return, in order to get back to where you were before in dollar terms. And then right on the right-hand side, and this reflected experience of it, equity markets during the financial crisis. Markets were down around about 50% at that time, and you actually needed a 100% positive return to get back to where you were at the beginning. And it's really important to bear those things in mind. We think about investment returns, but there is an asymmetry to that. It's the impact of compound interest through time. So essentially what that chart is showing you, it's really important to try and minimize the impact of negative markets, because the subsequent return you need to earn on your assets following a negative return is larger than the impact of the negative return itself. And so this is a really important lesson. And we do have to take investment risk in our portfolios, inevitably, but if we can take steps to minimize the negative returns, it can really provide positive or better outcomes for us over time. And on the next page, we wanted to introduce a concept here. It's not as well known as sort of compound interest and returns, but this particular set of metrics here. Upside, downside capture, and capture spread are, really important concepts when you're an investor who is drawing an income from your retirement savings. So if I could explain these concepts to you here and then show you, how they work through in practice. So the downside capture of an investment, would just be the proportionate movement of your investment when markets are negative. In this example on the left-hand side, when markets are down 10%, your investment might be down 8%, and so that gives you a downside capture there of 80%. Similarly for upside capture, so when we're only thinking about positive markets, if the market is up 10% in this example and the investment's up 9%, your upside capture is 90%. And in this example, you can see that the thing we've called capture spread is, it's just the difference between those two, upside minus downside. And in this example, it's 10%. And what's critical to appreciate really here is that we've managed to, with this investment here, they're shown in the blue bars on the charts there. We've managed to perform a little bit better than the market in down markets, and even though we've lagged in the up markets, the net impact will be a positive capture spread of 10%. And on the next chart, we can see why this is important. And this is actually a real example from actually a Fidelity Australian Equity Fund. And what I'll do is walk you through, what this would mean for an investor. Shown on the left-hand side there. If we think about investment returns through time, and I mentioned earlier on, we're most used to seeing investment returns presented over time. You can see the red line there is the market index, the ASX 200 for this particular fund, and then the blue line represents the performance of that equity fund. And these are real numbers going back to when this fund started back in June 2003. Almost a 20-year track record now. And this particular fund has investment characteristics summarized in the table there. So its upside capture is 106. That means it slightly outperforms the market when the market's going up. Downside capture is 95. So that means when if markets are down 10, this particular investment is down 9.5. So it outperforms a little bit in negative markets. And then you can see the spread there, which is just the upside minus downside, which is 11%. And those numbers may not look particularly spectacular, but if you then consider and look at the chart on the right-hand side, you think about someone who's retired. They might have a balance at retirement of, say, in this example, illustrative example, they've got $500,000 at the beginning of this period, and they're drawing a regular amount, $5,000. They're taking out, I think it's about 5% per annum or so from their retirement balance, and they're doing that every month over that whole period of time. And this, what this chart is seeking to illustrate is, what would be the investment outcome for that person who has invested over that period of time. And it should be, I think you'll see it's quite striking. The impact of the upside, downside, and the spread there is magnifies the difference in outcomes you might have expected. And that really illustrates, if you had a passive fund, which is the red line, or this particular investment there, the equity fund that's managed to mitigate the impact of negative markets just a little bit, and has managed to outperform a little bit in up markets. At the end of that 20-year period there, you can see the investor who's invested in the market, a passive fund, has only got around $50,000 left in their portfolio, whereas the blue line has still got about 850,000 left in there. So a huge difference between the two. And it's that impact of compound interest, being able to mitigate the impact of negative markets, absolutely critical particularly for investors who are in retirement drawing a regular income. You still got a period of time in your retirement in which you have to take investment risk, take some measured investment risk, and if you have the exposure to these kinds of equity or growth assets, then the impact of negative markets can be greatly mitigated. Okay, so I hope that was useful to illustrate that concept. On the next slide, just to talk about inflation risk, we mentioned this impact of inflation, and it can be very, very significant. When the average Australian retires, in their sort of mid-60s, they can expect to live for between 20 or 30 years. Average expectation is around 28 years, and there's a significant number who will live beyond that. And so if we look at the impact of inflation over that period of time, and with fairly benign inflation around 2.5%, as we see in that sort of middle column there, after 10 years, your $100 that you might have had at the beginning is worth only $72. We've lost 28% of the purchasing power of the assets that we have. And after 20 years, 63.9% of our purchasing power has been lost through the impact of inflation. And that 5% inflation, and of course, as I'm sure you're aware, inflation is currently above 5%. It's around 7%. We're expecting that's a short-term impact. For many years up to last year, inflation was running at 2 to 3% at the most. So hopefully this period of high inflation we're experiencing at the moment is short-lived. But if 5% were to persist for a period of time, for example, 10 years, as you can see in the right-hand column, it would, after 10 years, we would have lost 62.9% of our purchasing power, through the impact of inflation. And so it's really important to be aware of that. We have to manage inflation risk through time. If we're not having the right sorts of assets in our investment portfolio that can keep pace with inflation, we risk losing all of that purchasing power. So important impact to be aware of. Okay, on the next slide, just to give you a flavour of, we talked about longevity risk, this is it's a thing that that many retirees think about, and useful to know what sort of life expectations we might see, and this is average life expectations of a 60-year-old retiring. On the right hand side, if you were to have retired in that in the 90s, the mid 90s, life expectations for a male were 20 years, so you would have on average lasted till age 80. And for females it was 24 years, so age 84. But if we look on the left hand side there, we can see how longevity or life expectancy has been improving happily through time, with improvements in diet and medical science. People are living longer these days, and so based on mortality experience from 2015, the mid 2015 period of time, from the government actuarial tables, males are now living on average 24 years and females 26, 27 years if they were to retire at age 60. So life expectancy is increasing, which is great, of course. It gives us an idea of what our sort of time horizons are, at those, when we do retire. And of course, these are averages here, and averages can mask some of the impact. So there will be 50% of the population will live longer than what is shown on those charts there, and that's worth bearing in mind. Whilst obviously some will die a bit earlier, it's 50% by definition will live longer than what's shown on there, and of course we don't know as individuals how long we're going to live, and so it is useful to think about the possibility of living longer than what is shown on those averages there, because that could easily what happens to us. Okay, so that's longevity risk. On the next slide, really just to close out the discussion. For those who are not familiar with some of the investment options we have at Fidelity, and we do have quite a number of self-managed super fund investors happily with us already. This is the full suite of investment funds available either on exchange. On the right-hand side there, we have ETFs that are available on exchange, or our traditional sort of managed funds are shown in the other boxes there. Quite a broad range of global equities, Australian equities, Asia as well, and actually we also have a fixed income fund we launched quite recently as an income offering for those in retirement. So a broad range of funds there, and what I'll do now is hand back to Sarah just to close off, and thank you for listening in.
Thank you, Richard. If we can go on to the next slide, please. Just before we close out, it's just to say thank you very much for today. We'll go into a couple of Q&As. We've got a couple of questions that have popped up, but this is just really how to stay informed. So from today, there is an Insights and News section on the website if you want to stay informed with Fidelity's news and insights. It just gives a bit of a market update. You can see the kinds of themes we run through and some top picks that clients have looked at quite recently. There's another section that is quite useful to advisors and brokers. Inside that, you've got webinars, fund platform availability, performances, any kind of training, charts, and some white papers. So post this webinar, the Q&A section, we'll be sending out a copy of the recording, as well as the report that Richard's kindly taken us through. So the report was quite interesting because I think it offers advisors and or investors different ways to navigate, and some tools and tips there around, what more can you do as you're approaching, because I guess it looks like retirement's about 3 steps. So you're kind of getting into it. You've got to identify the transition path, and then you're in transition, and then you've got the retirement journey. And as life is a bit of I guess it's a snakes and ladders kind of situation where you sort of don't know whether you're up or down. So there's a couple of interesting questions that come through. So let's start with, Richard, why do you think retirees are the most life satisfied despite depleting physical and financial resources?
Yeah, so that was one of the outcomes from one of those research pieces there. We found that those who are already in retirement and have been in retirement for a while actually have the highest levels of life satisfaction, and that was a pleasing result from the research. It's great to see that those who have saved a long time for retirement and now they're in retirement, they did have the highest level of sort of life satisfaction and happiness. Those who are building up to retirement weren't quite as happy, and that I guess a little bit concerned about what lay ahead, and were uncertain about if they had saved enough, and how to navigate some of the complexities of superannuation, etc. So there were some parts of the survey respondents who weren't as happy, and it was mainly those who were building up to retirement or early on in the retirement stage. But yeah, so in terms of the reasons why, well, I think those who have been in retirement for quite a while have settled into a rhythm. They've got familiar with a new stage of their life. So despite advancing age and probably health not quite as good as it would have been when they were younger, they've established themselves in communities. They're doing the things that they enjoy doing, enjoying simple things like spending time with friends, family, etc., hobbies, and importantly, they've around the finances. They've people worry about quite a bit about their finances in the build up to retirement, but once people are in retirement, they've generally figured out how much they how much they can survive on, what is their how to adjust their savings according to their needs and their wants, and those uncertainties have been removed. They've been able to figure out how to cope well with retirement. So yes, it was a great result from the research that retirees are pretty satisfied with the way they're running through retirement.
Thank you, Richard. There are a couple of other questions, but we've just had time, unfortunately. So I might just close out this section, and thank you very much for taking the time to listen in today. We'll send out a recording of the webinar along with the white paper over the next few days. And we just want to say, enjoy the rest of your day. And thank you very much again for Fidelity International. And thanks, Richard, for taking the time to present with us today. Goodbye.